Well, good afternoon, good morning. I'm Andrew Muldoon, the Vice President of Philanthropic Engagement with Rochester Area Community Foundation, and we're so glad that you're able to be here today and join us for an investment briefing from Mike Miller, our investment consultant. Before we get started, I'd love to just give you a quick rundown on some housekeeping to help you navigate this webinar a little bit easier. If you haven't attended a webinar before, here are a few things that I think will help you to control your experience. So there's a control panel on the right of your screen. You can open or close that by clicking the orange arrow. If the audio was not automatically selected for you, you can select whether you're using audio from your computer or your phone in the audio pane. For the best experience, click on the View tab and select Full Screen. Your camera will be off and your mic will be muted for the duration of the webinar. But if you'd like to ask Mike any questions, type them in the questions pane and hit enter or click send, and I'll make sure that we bring them to Mike's attention during the program today. Today's presentation will be recorded, so if you'd like to watch it again, look for it on our website tomorrow. And if you're having any technical issues, please give our colleague a call, Kaylee Mahar, at 341-4331. Now with that, I'd like to introduce Jennifer Leonard to kick things off. Thank you, Jennifer.
Thank you, Andrew, and welcome everyone, and thank you for joining us this morning. We truly appreciate your philanthropic support for our community and its community foundation. Thank you for supporting the Community Crisis Fund, co-led by United Way and Community Foundation together with other philanthropies. We are also working to assist students with technology access, support arts organizations, and plan for the recovery of our damaged nonprofit sector. Our community foundation is able to respond at times like these because of philanthropic support from generations of donors and a strong investment program that has preserved and grown donor gifts over time. Now, of course, we are experiencing an unsettling period personally, for our families, and in the markets. Fortunately, the Community Foundation's long-term investment program has weathered a lot in the past, thanks to its investment discipline and for sticking to its knitting at times like this. We are so fortunate to have in our corner, as our investment consultant, Michael Miller of Colonial Consulting, whose popular November talk to donors helps us make sense even in challenging times. Mike is a founder and chief investment officer of Colonial Consulting. He provides the firm's clients with advice on asset allocation, manager selection, and performance evaluation. He has over 30 years of experience in the consulting business, all with Colonial Consulting. Mike holds a bachelor's degree in computer science and a master's in statistics, both from Columbia University. He has been awarded the Chartered Financial Analyst, or CFA, designation. Colonial Consulting is a New York-based firm that focuses on providing consulting services to not-for-profit institutions. Founded in 1980, the firm is owned by its employees. At present, Colonial has more than 140 client relationships representing approximately $38 billion in capital. Mike has been our investment consultant since 2003. We are very happy to have him here this morning to present an overview of the Foundation's investment program in the time of COVID-19. Mike, thank you.
Thank you so much, Jennifer. It's a real honor to be with everyone this morning in these very trying times. I also want to extend my best to all of you, your families, your colleagues for continued good health and safety at this very, very challenging time. What I'd like to do today is take a page out of our normal November presentation, which I very much hope we'll be doing in November, and talk about what's gone on in the markets more recently. We've obviously, as you're well aware, had some significant we would think short-term losses in the portfolio, which I will talk about a little bit what's behind those today. And I'm glad to say there has been some meaningful recovery since the end of the quarter. So we'll talk a little bit about that as well. So we're going to dive into some slides, I believe. There we go. Perfect. So as Jennifer said, there are certain hallmarks of great long-term investing that really do serve us well at times like these. And I want to be clear, everyone on this call is well aware of the fact that we are in an unprecedented situation. And this is the first of many unprecedented situations, not the first of, it's one of many unprecedented situations that we've had over time and will have again in the future. And at these times, it's important to stay grounded in the long-term principles that guide us well, but to also be of the mind of thinking about how things are different right now and how we adjust the portfolio and the strategy at the lowest levels to be sure that we're not taking on risks that might be different this time. So I'll talk about that a little bit today as well. So it's a balancing act, but I really want to be clear the balance is towards the long term and the principles that have always guided us here at the foundation in terms of strategy. So now the slide you're looking at today is a lot of numbers, and I apologize, as Jennifer said, I have a master's degree in statistics, and so I probably am too enamored with numbers for most people, but let me walk you through this because I think it's an incredibly important set of information that you'll see in front of you. So what we did is we looked back at the longer term history, or really over the last 30 years now, of performance for the portfolio, and actually 20 years, and looked at the largest sell-offs that have occurred over time. And there have been 4 before the one we're in right now where returns were more than negative 10%. And so we talk about a drawdown. That refers to the peak to the bottom, essentially, in terms of the loss. So we haven't listed this one yet because we're hopeful that we've seen the bottom, but we don't know that yet, so we can't list it. So each of those 4 periods are listed here, and you can see in the first column, we show the dates that those drawdowns occurred. So you'll see, the first one was in 2001 from February till September. Most of us are still well aware of the one that happened after that, which is the global financial crisis from 2007 to 2009. And there have been 2 other sell-offs in the last, basically 20 years that were significant. We put a third column in. So the second column is the loss to date. You will see on the next slide that this particular drawdown we're in now has been about a 20% loss. So it's amongst the worst, but not the worst we've had. Things have gotten much better. I'll come into that in a moment. But when you look at the third column, you'll see that the portfolio has actually, in all these cases, including, and not yet in the one we're in now, but soon to be, has outperformed the S&P 500, during the drawdown period. But it's the 4th and 5th columns that I really want you to focus on, which is that when you're in the midst of these really big sell-offs, they happen for reasons, and this one is very obvious what the reason is, and they feel unending at times, and they're very, a lot of pessimism can build up in our systems, especially when our entire lives have been upended the way they have been in this situation. But when you look at that column, the time until the high water mark was regained, what that means in English is when was that loss fully recovered? Many of you know one of the pieces of math that is a little disappointing and disturbing and worrisome at times like this is when you lose, for example, we never have, but if you lost 50% of your money, you need to make 100% on what's left to get back to where you started. So that column takes all that into account. And so even in the worst case, which was the global financial crisis, you can see it took less than 2 years to get back all the losses that occurred over that period of time from 2007 to 2009. And it's very, very, very interesting if you think about how quickly things can come back when the time is right. The 5th column is also important, which is that none of us really know exactly what the future holds. We really never do. And it's important to know that from your perspective that the foundation strategy doesn't succeed if you get the timing right. So in other words, for example, if you added to your fund at the earlier part of this year when this drawdown started, you might say, well, am I ever going to catch up? Am I ever going to do well? And the answer is actually if you take a 5-year view, at least over the 3 drawdowns in the past, where we have 5 years have occurred since the starting of those drawdowns, the returns are positive in every case. Even the global financial crisis wasn't a great return, but the return that was the capital that was lost came back, and you earned a admittedly piddling 2.7% per year return on your investment. The other 2 actually aren't so bad, just under 6% per year, even with the worst possible timing. So the point I wanted to make to you all is that we have been here before. We have not been in the pandemic before, but we've been in a very challenging situation, and we are allocating the portfolio in such a way as to play by the rules we know work and also to make some adjustments along the way in terms of how this is different this time. So let me move on to the next slide if we could. So here's a look at the performance. As I mentioned earlier, it was a very tough start to the year, and you can see the blue bar is the Community Foundation return, and the green bar is the benchmark. I'm going to be a bit dismissive of the underperformance that occurred lately. It's really been a function of two things. One is that we actually believe very strongly that price matters in investing and that margin of safety matters. That sometimes leads to the word value investing. It's not exactly what we're doing because this portfolio is very balanced, but we've had value-oriented strategies in the portfolio which are not serving us well here, but we're very confident will serve us well in the long term, and I'll show you why we think that way a little bit later. But what I wanted to emphasize is two quick things. So one is, as you start looking at the longer time periods, particularly 10 years where the return is actually good, still a little bit behind our benchmark, but we're within striking range, and a lot of that happened recently. 15 years where there's a premium and a very strong compound return, and 20 years, which I think really reflects the wisdom of this strategy and its real time horizon, where the portfolio has earned 177%. That's not per year, of course, that's cumulatively over the 20 years, compared to only 119% for the benchmark. Despite all of the complications of today and the challenges we face, the conditions right now in the markets are setting us up for the kinds of outcomes that you see over these very long periods of time. One more slightly optimistic note, the negative 20% loss that you see in the first quarter of this year is actually, through last night, become quite a bit smaller. It's actually down to about a 13 to 13.5% loss, so hardly something to jump up and down with joy about, but the 20% number we hope is in the distant past. We don't know that, but nevertheless, we're quite confident the portfolio is very well positioned for the recovery that will occur, and that's what you're starting to see in the gap being closed already from what's happened this year. So the next slide takes a look at the governance structure, because I want to remind everyone how this works. Jennifer correctly identified me as the consultant. So what that means is we are the advisors to the committee. The committee is ultimately making the decisions about asset allocation and manager selection. Investment managers, third parties, are hired as our index funds to actually manage the assets. So neither the committee nor Colonial Consulting is picking stocks. We're picking people who pick stocks, or we're picking index funds that buy indices. The strategy is one that we've used for a very long time, as you know, and I want to emphasize the fact that one of the secret sauce pieces of this, in my mind, is the presence of an extremely talented investment committee, which has a view of how to do long-term investing that's very much copacetic with ours. And that combination of bringing together different perspectives, but a basic agreement on what the long-term goals are and how we should get there has been the power of this of our success over all these years. So the next slide is also a part of the secret sauce, and Jennifer referred to time-tested principles, and these are them. So the first one is to stay focused on our long-term return objectives. So I might be dismissive of 1 year or 3 years, and it's not because we're not paying attention. We pay very close attention to what's going on, but because we're really here to provide the returns that are needed to support philanthropy and your philanthropy and those of others for 10, 15, 20, 30, 50 years. And we make our decisions very much with that in mind. We're not interested in looking like short-term heroes or sleeping well at night. We're interested in what will be left for this community in the decades that follow. The second bullet point is the great temptation that we find today, which is that everybody wants to figure out what's going to happen next. And the reality is, one of the things that's psychologically always been fascinating to me is that in big up or big down markets, people seem to get confident that they know what's going to happen next. It's just going to be a continuation of the trend in place. That's not how things work. Unfortunately, it's been a very, very hard and sad lesson for most of us to deal with. But this pandemic is a perfect example of the fact that the world's an uncertain place. Things come out of nowhere, both good and bad. And we need to not be building investment strategies based on something we cannot know, which is the future. But what we can do, which is the third bullet point, is diversify. And diversification is something that always comes under fire when there's one part that's working better than other parts of a portfolio. And one of the other really important parts of our strategy here is the committee is very focused, as is our firm, on staying diversified. That means we do own things that are doing really well right now, and we own things that are not doing as well right now. And the beauty of it is that they will all do well over long periods of time, and they counterbalance each other. So if you think about it, we're not trying to achieve perfection in the short term, because that would look like owning only the things that are working. We're trying to own both good and bad, because we know that they'll switch positions at different points in time. And I'm going to come back to that a little later when we talk about the challenges of being a value-oriented investor today. So on the next slide, I want to remind you of some of the history here. So for 23 years, the endowment, the blended endowment at the Community Foundation was invested 70% in stocks and 30% in fixed income. About 7 years ago, we made a shift in the portfolio, which is the next bullet point, which shows it was 7 years ago, thank you, which shows that we made a change, which is low interest rates led us to say, you know what, an endowment's going to have a hard time earning 7-8% net returns per year in a world where interest rates are 1 to 2%. Now, they're even lower today, which makes this decision actually even more of a wise one. But right now, it's a challenging one because of what markets are doing. But 70% stock still, so we didn't change that. Only 20% in bonds compared to 30. 20 is still enough to have given the portfolio some protection, and 10% in alternatives, which is largely in equity-oriented hedge fund managers. And so this mix is expected to generate very strong long-term returns, as the 70-30 mix did for many, many years. I will tell you, if interest rates were to magically go back up to more normal levels, I know the Community Foundation will be very happy to own more bonds again. But with rates as low as they are today, we need to, again, try to get this balance right between long-term and short-term and protecting this portfolio from really both sets of scenarios. So the next slide is a quick look at manager due diligence. I'm going to run through this one fairly quickly because I want to turn our attention to the areas that we're focused on now. But there are certain rules that you should follow when hiring active managers. As a reminder, we have both active managers and index funds in this portfolio. We're believers that they both help each other and counterbalance each other quite a bit. So the rules are simple. Rule 1, return is always accompanied by risk. And when you keep that in mind, it's extremely good for keeping yourselves out of trouble. So whenever I know when we're presented with a return, with an idea that seems not have a lot of risk, we always realize two things. One is that we just must not understand the risk, or two, there won't be any return if there's no risk. And so you have to accept that premise, I think, to be a successful long-term investor. And what we do in the portfolio is combine those risks in such a way that we can get diversification, as I mentioned earlier. If we continue down for another bullet point or two, one of the critical elements of the strategy today, which is proving to be very, very important, is to know the people who manage money for the foundation. So in the old world, we would log, personally millions of miles across our firm, visiting managers around the world, of course, in our own country as well, and making sure we knew them, not just what they do, but how they do it, how they think, how they see the world. That's proven to be extremely valuable. I will come back to that in a minute or two. There's a third element to this, which is to never take risk from an operational standpoint. And so I'll go by this real quickly because I just want to mention it's a very rigorous process executed by the foundation, by its auditor, and by us. There have not been issues, and there have been no issues, by the way, in the COVID-19 situation either. So we'll keep going. And the fourth bullet point, this is a forward-looking process. One of the great mistakes that people make is they look at a set of returns and they say, oh, that's done better than that, so it must be better. But the reality is that the world is cyclical, and you need to be very careful about trends and the end of such trends. So the next slide takes us to something a little more timely, which is what's happening now. I mentioned earlier we're making some adjustments. We're not making adjustments in the strategies, to be very clear what that means, but we are adjusting the way we think about the people managing the money and what we expect them to do, because we are in a different place right now. So this first bullet point is actually a very big, long point I'll make short, which is that we live in a world now where economic outcomes are just different and wider than we would have ever imagined before. Just to give it a quick and obvious illustration, the idea that we could have companies with no revenue for a year, large publicly traded companies would have been insane as recently as 3 or 4 months ago, and now it's not. And so we're not suggesting that we know the future, but we do expect and a demand, in fact, and are getting investment firms that are thinking about the world in a very different way as they value businesses. Because the ultimate point here is that the value of a company is something that can be figured out. It's a question of what kind of cash will it generate for shareholders over long periods of time. That's the value of a business. The stock market is something totally different, but our managers are very focused on what are things worth, and when the stock prices are attractive, we want to own them, and when the stock prices are not attractive, we don't. The second bullet point is also extremely important. We're all being affected by this crisis in very different ways. For example, I'm already worried that we're not going to have a November meeting together. I hope we do. But the world's different, and our lives are different, and it affects us all in very, very significant and varied ways. And the investment managers who work for the foundation are human beings as well. And so we are very focused on whether or not they're maintaining their composure. I am very glad to say that the foundation has a 100% hit rate right now in terms of success on this point. But the game, unfortunately, is not over yet, and we will continue to be incredibly vigilant about making sure that people are maintaining their composure. I can talk more about that if anyone would like to hear more later. The third point is that there's another side of all this, particularly for liquid, stable, successful organizations like the Community Foundation, which is that we can play offense here, and we can sit back and wait for really amazing opportunities to come along. And while a lot of people see the active management community as a commodity product, it's really not. There's a wide variety of people out there managing money. Some of them are very, very bad at what they do, and some of them are very, very good at what they do. And there's a whole bunch in the middle. There's a group at the very top of the class, some of which are already in this portfolio, which we think are the best of the best. And they're sometimes very hard to put money with because they just don't want to manage a lot of money. They just want to do a really good job for the money they have. So but when markets start to collapse and people start to get very nervous like they are today, some of those firms become available to us. And so one of the things that we're kind of waiting to see, we hope it doesn't get too good, because if it does, that means the world's going to be a very hard place for a while. But opportunities will present themselves, and the committee will consider those. And I mentioned the governance model earlier one more time. We're not shy, as you might guess, about bringing ideas to the committee, and it's up to them to decide whether those ideas are worthy or not. And our partnership with the committee and the foundation over the years has been successful because of that, that check and balance that exists in the system. So the next slide is really the things that we've advised the committee to think about. The first is to stay balanced. Again, there's a great desire amongst many of us to, for example, run away from the areas that are most unpopular and most scary right now, and maybe towards the areas that seem like they're most likely to be successful. The problem is that, again, the future is still a mysterious thing, and there's a lot of complicated stuff going on right now. And the best way, in our mind, to think about complexity is to not lose sight of balance, and balance is another word for diversification. The second bullet point also refers to a critical issue, which is that there are some extraordinary opportunities being created as we speak. Now, they must be heavily vetted with rigorous analysis. You can't run in and just start buying things because they've gotten eviscerated in terms of their price. But there are some things that have been sold off for no reason that makes any sense from a 2 to 3 year window, even forgetting about longer term. So we're very cognizant of the fact that we don't want to miss these opportunities. I'll tell you a quick story about a manager who's not in this portfolio that I think may be in the future. And I was talking to him about a month ago, and he made the point that if you work in the investment industry for, let's say, 50 years, you might get 2 or 3 chances that look this good in terms of the opportunity set. And again, that doesn't mean the world's going to get better in the short term, to be very clear. It doesn't even mean that the portfolio will do well in the short term, but it means that you'll look back 5 or 10 or 15 years from now and just almost be stunned that you could buy some businesses at these prices because they're so cheap today. The third bullet here, last but not least, is price matters in investing. I want to come back to that in a minute, but again, as you watch the markets kind of sway around and dive and dance and run towards the things that look like they're doing well right now, and some of those are doing well and they will continue to do well, but you can't overpay for things, because once you overpay, you take on a lot of risk that nobody can deliver on what you're paying for, essentially. And there's a huge risk today in these popularity contests with all the emotion going on. And we are very focused. And I would ask you in your own portfolios to stay very focused on the things that are making you feel good. Might actually be very, very good, but they should also be the things that you're most worried about, believe it or not. It's the stuff that's bothering you the most that you maybe should be worried about less. Again, assuming you own things that are ultimately going to survive all of this. So the next slide turns our attention to that last point I wanted to cover, which is to talk about this idea of value versus growth. Now, I know a lot of you probably don't spend your days thinking about this, so let me give you a quick definition, if I might. Value stocks are stocks that, according to index providers, which is what we're showing you here, are cheap. And they tend to be cheap for a reason, which is they're slower growth, they're no growth, they're shrinking growth, they're cyclical, they're complex, they might be turnaround situations. There's a whole bunch of reasons why something gets cheap. It's not usually good things, by the way, happening, just to be clear. Growth stocks, on the other hand, are the things that we all naturally feel more comfortable with. They're growing companies, they're successful companies, they're, things are good, and everybody loves those, and they always love those, by the way. But the reality is that investing doesn't work that way exactly. It's not about figuring out what's good all the time and what's bad. It's about figuring out what's in the price. So we've been through a period of really for quite some time now where the growth part of the world is doing much, much better than the value part of the world. And when I say the world, I mean within the United States. So these lines you're looking at on this slide show you rolling 10-year returns all the way back to the late 70s, which is when these indices were created. For value, the blue line, and growth, the orange line. And it really is interesting. So if you look to the very far right-hand side of the screen, you can see that the orange line has been ahead of the blue line for quite some time. And that's where the current popularity of growth strategies comes from, is everyone looks at the facts in front of them and says, wow, this is better. And it's very interesting because it also ties into what we want to believe, which is that we'd like to own less risky things. We'd like to own the winners. Who wants to be with the losers? But the way the investing works isn't quite that simple. And if you look at the longer time periods we're showing you here, yes, growth has had its days in the sun before, but value, if we turn to the next slide, actually has its day in the sun more often. And the reason for that isn't that good is worse than bad. It's that human behavior is a fascinating thing, and taking the other side of it is a really good strategy. And by that I mean growth is great, but people tend to get too excited about it, and it disappoints. Value is not something people want to own, but people get too discouraged and depressed about it, and it gets too cheap. And it's even with low expectations, it does better. And it's for this reason that value indices have outperformed growth 60% of the time. So if you were able to take my spreadsheet from the prior graph and added up all the 10-year periods where value did better than growth, it would have been 60% of the time. I would also add that if you took out, and I wouldn't take this out, but I'll just mention this to you, if you took out the recent 10 years or so, you'd find that value outperforms 70% of the time. So the dominance is quite strong, and it's not temporary, and it's not a relic of the past. It's the way human behavior works, and that's why we're very confident that part's not going to change. The second bullet point here also points out something which is extremely important for long-term investors, which is that essentially because growth stocks get ahead of themselves, and despite the fact, and even though they're superior businesses, they've actually had negative returns 7 times as often almost as value stocks. And I make a big deal about that because if you think about our 70-20-10, or before that our 70%, 30% portfolio exposure, the goal of which, if we all remember, is to support philanthropy in this community for the decades to come. We can't afford to make that mistake and get it wrong for a whole 10-year period. Even the graph I showed at the beginning, we've had good returns in this portfolio for 10 years, despite this very ugly endpoint we have right now. But the point I really want you to think about is that if something has less chance of losing money over 10-year periods, that is a better thing for us to own the portfolio. So 1 or 2 more slides, I believe. So our strategy today is the same as it always is, which is to always be consistent. The foundation keeps that pool at 70-20-10 on a very consistent basis, and that's what allows us to generate the kinds of returns that you've seen before. And again, maintaining consistency, another word for that is rebalancing. And rebalancing is something that people generally don't like to do, particularly in a falling market. But that's the best time to do it. And in a rising market, we go the other way, and we sell stocks and buy bonds and buy other investments as well. The second bullet point, also very important. Unfortunately, we do live in a time where it's not just emotion. It's just life-changing, disruptive events. Everyone's got so much to think about these days, and just adjusting to all of our lives at the moment is hard. And that, unfortunately, is bad. And we can't change that. So what we do is the second best thing, I suppose, if there is a best thing, which is to at least try to build a portfolio that takes the other side of that is willing to own things that people have left for dead but that won't die. And that's a really important part of where we're heading here. And that's where the value in the portfolio is going to be coming from in the future. And then last but not least, having hundreds of millions of dollars, thanks to those of you on this webinar and elsewhere, of course, in the community and past generations, where the foundation has been able to build not just a world-class investment program, but a world-class investment committee and a world-class portfolio. And that comes from the knowledge of the committee members. We do our part to support their talent. And that's what's led to these really, really great long-term returns you've seen. And I really very much look forward to showing you great long-term returns, particularly from this point in time. I want to remind everyone of one thing, which is back in the last presentation I believe we did in November, I made the point that it was kind of stunning to see how large the returns had been in November 2019, pointing out, and I did it the year before too in 2018, pointing out that back at that time in the beginning, 2008, 2009, things looked very, very bleak, and waking up 10 years later and seeing really massive returns was even a little surprising to us. We weren't expecting to be quite that good. This time, I think this time will be the same. So I hope I have the chance to see all of you in November of 2030 and have the same exact conversation, but we'll have to wait for that day to come. So I'm going to stop there and pass it back to Andrew, I believe.
Thank you so much, Mike. We do have some questions from the audience, and we'll do our best to work our way through them. If we don't get to your question right now, I will follow up with Mike, and we'll do our very best to get a response back to you all very quickly. So if we could, let's start with a question about investment managers. Mike, what are the key attributes which show an investment manager is maintaining their composure or not in a time like this?
Yeah, so there's a lot of very interesting parts of this. So let me start with what I mentioned in the presentation, which is that we really know these people, and we know them over the course of many, many years. So, one of the ways is, I'm sure all of you do in your lives, in a relationship of any kind, the more time you spend with each other, the more you get to know people. You get to know their nuances, their quirks, their behavior. So the way we have applied those lessons to today is we have to do it this way now. We used to go visit them all the time, of course, so now we get on Zoom calls and sometimes phone calls, and we talk to them, and we ask them questions about, well, what's going on in the markets? What are you doing in your portfolio? How are you thinking about things on a go-forward basis? And we're both gathering information because they're all helping us figure out what is going on in this world. That's one of the wonderful things about the seat we get to sit in, is get to talk to literally hundreds of great investors. And we don't agree with them all, of course, but we get to kind of create the mosaic theory where things are put together and give us a picture that makes some sense that we can come out and communicate to our clients. So one thing is we're gathering information. The second thing, though, which is the more important part, is we're listening for subtle change, for someone saying, well, I'm thinking about things this way. And that wouldn't mean anything to someone who hadn't talked to them 10 times before. But if it's different enough than other things they've said to us for a long time, we take notice of that. And I want to come back to that in 1 minute, in a second, if I might. The second thing, though, we're doing in terms of making sure people are keeping their composure is not just letting them tell us what they're doing, but looking at what they're doing. So we get holdings information from them in many cases. In cases where that's not provided, for example, I get all excited. It's almost May 15th, and the reason I get super excited this time every quarter is the SEC's public filing deadline is about to come out, and we get to look at what everybody's doing in their public filings, which is another piece of data that we use to decide whether people are keeping their composure. So it's knowledge of a strategy, listening to what people are saying, and then basically checking on that in terms of what they write, what they say, and what they do. And the last point I want to emphasize for a minute is what we have learned, though, and this has been different this time, is the data point you get about composure can shift a little bit over time. So we've had, not in this portfolio to be clear, but others, we've had managers who looked like they were keeping their composure, but then when you check in them 3 weeks later, it's a little different, sometimes worse. We've had a couple that thought, I'm getting a little nervous, like maybe they're not keeping their composure. You talk to them 3 weeks later, and they absolutely were. So multiple touch points in a volatile time is really important. And I think the team at Colonial is getting a little tired of hearing me say, okay, let's go back and do it one more time. And I'm just going to keep saying that to them, and eventually they'll just know to keep doing it. But that's how we're doing these things. So it's really, really important. Because I do want to just emphasize, I'm sorry to make this a little long-winded answer. The committee and us as Colonial and the foundation can be disciplined. But if our managers are not being disciplined, then we will have been wasting our time, which is why this is so important to get right.
Mike, do you mind sharing how frequently we rebalance our portfolio?
Yes, I do not mind. So right now it is a quarterly process where the portfolio is between the stock portfolio, the bond portfolio, alternative portfolio is rebalanced by the foundation, and I work with Amy Vars and her team to make sure that happens, although Amy does all the real work. I just get to answer an email or two or do a phone call, so I don't want to take any credit for all the incredible efforts of Amy and her team. So that's one part of it. The committee also, though, on a regular basis, looks at within the pools when things get too far away from their targets and they rebalance as needed. So it's not a continuous process. We do like the idea inside the pools of letting a little bit of momentum take the portfolio away from its targets, and then we bring it back before it gets too far away, because markets do show momentum, as we know, but we don't want to take the risk of being too far from the targets.
Great. Thanks. Mike, a question about sort of our recent history. A few years ago, you explained that some of the investments had an individually greater risk than typical institutional investments, but collectively they present lesser risk. Do you mind providing a little bit of insight as to how that actually worked in this downturn?
Yeah, that's a great question. In fact, it didn't work, to be perfectly frank. What happened was risk strategies like the one we use, which is based on diversification, had no meaning whatsoever in the first quarter. In fact, it was really interesting. I want to even be more specific about this. It wasn't the first quarter that it didn't work. It was really it was really the month of March it didn't work. And this was disappointing to us, but also not an entirely surprising event. Some would argue that the weakness of a strategy comes out in times of panic. I don't think I agree with that. I would say instead that bizarre things happen in times of panic. And you know the difference between bizarre and weakness by watching what happens afterwards. So even though I think we face a very difficult economic situation globally for quite some time, that's at least our base case assumption right now. We hope that's wrong. But the reality, though, is that what happened in March, where we all woke up and started to realize that our economy was shutting down, our lives are being completely upended, even if things are not good for a few years, that shock will not be the same in June or August or October or, God forbid, next year. And that's the panic part of this in the markets, was just that shock. So what I'm trying to say is that we've already seen it in April into early May, the diversification working really, really well again, but we're playing catch up. So when you look at that first quarter data point, I would ask you to be somewhat careful about it, because it reflects panic and a little bit of insanity and not really rational, calm thinking. And that's what we're starting to see now. So you don't have to wait forever to see that what I'm saying is the case, that the diversification will work again. And we're already starting to see that right now.
And Mike, sort of a follow-on to that, what about domestic versus global diversification? Does this current crisis impact the way you're looking at the bigger picture there?
It does, in the sense that I think that you have to, again, go back to price again. So in domestic markets, the U.S. market, which, by the way, is our market of choice, we're in the United States. We want to own as much in the United States as possible. But the United States markets, to a large extent, are pricing in more optimistic scenarios, particularly in some areas than others. That's not all U.S. companies, to be clear. So that leads us to want to own non-U.S. stocks. And what is interesting, I will say, is I think that while nobody really is looking at it this way right now, margin of safety really does matter. And paying for more pessimistic outcomes, which is what you see a lot outside the United States today and within certain parts of the U.S., seems to us to be a very logical thing to want to do in a world that is absolutely currently different and likely to be different going forward than the one we came into this with. And the changes are impossible to predict, so I'm not going to do any fortune telling and tell you exactly what's going to happen. We have our suspicions of certain things, and I'd be happy to talk through those if you'd like. But different is the operative word, and that means risk. And risk is something that you can cover as an investor by paying less for things. So the long-winded answer to the question is, we are thinking about things a little differently in terms of what global looks like and what relies upon. But we're being compensated through very low prices to stick with a geographically diversified strategy with a bias to the U.S., just to be clear.
Great. Thanks. And Mike, as we talk about our portfolio and just investment choices, do you mind sharing a little bit about where social responsibility plays in on that and how we sort of weigh that as part of that measure?
Yes, so we're very focused on social responsibility as a group. The foundation is very focused on it. And the way it works its way into our world very specifically within this portfolio is a really heavy-duty focus on what we call ESG, which is environmental, social, and governance issues. Now, ESG, just to be clear, is not an exclusionary strategy. It's a strategy that says that environmental issues, social issues, and governance issues are risks. And that you need to account for those when you look at companies. So I talked earlier about the idea that as investors, we wanted our managers, expected our managers to model things they hadn't modeled before, like no revenue, for example, for a year. Well, we also expect them to model in risks of, being a bad citizen in a community. What is the liability associated with that? Having a product that hurts people, all kinds, treating your own labor force badly, things like that. Again, they don't mean you won't invest in certain areas, but you need to get paid to do it, i.e. the prices have to be really low and account for those risks. So that's an integral part of the strategy and actually has been for many, many years.
Great, thanks. And we've got time for just a couple more. They're related. So would you mind just sharing the methodology for determining value versus growth in our portfolio?
Yes. So what I was showing you before were indices, and indices do it, and that's not exactly what a portfolio does, so there's going to be a two-part answer. Indices base that on backward-looking data. Which companies are growing the fastest? Which ones are the most expensive? And which ones are the highest quality from that perspective? They go in the growth indices, and everything else goes in the value indices. Now, our view of that is a little bit different. So one is we do use indexes, value and growth indexes. So we're definitely putting that methodology into the portfolio, which is important. But we also have, on the active side, a very different strategy, which is that we're not really interested in assuming that bad things will get better. That's kind of sometimes referred to as mean reversion. It sort of works in investment markets, but it's not something we want to put a lot of eggs in that basket. So the way we separate the world of value and growth is quite simple. Do you fundamentally look at companies when you value them on a backward or forward-looking basis? So value investors look backwards, and they say, well, this is cheap right now based on what it's already done for us. Growth investors look ahead and say, well, I think Amazon is going to earn this much money 5 years from now, and if I discount that back by a reasonable rate of return, the stock is still cheap today. And I'm not making that statement. I'm just saying it could be hypothetically. Now, the reason that distinction is so important is it's not about the businesses per se. Every investor, our value investors and our growth investors, look ahead and try to decide whether this is a company that's going to do well or not. We don't have anybody saying, well, I don't really care if the business survives as long as it's cheap. They do care, and they do care about the competitive landscape, the quality of the management team, the products these firms and services they offer, what kind of markets they are selling into, et cetera, et cetera, et cetera. But the difference, back to the beginning, is are they willing to pay for the future or only for the past? That's a value investor in the latter case, and it's a growth investor in the former case. And I think that's the rational way to deal with price and investing.
Thanks, Mike. And sort of to that point, what about undervalued small caps?
Yeah, an area that, by the way, this is where it's interesting. Probably one of the most interesting areas you could find, as long as you can pick the right companies, of course, because the narrative right now, and this is what happens in markets, and I find it sometimes a little frustrating, but it does go away eventually, but it's a little frustrating when it's happening, which is that there are very simple stories that get built up. And one of the simple stories today is that you don't want to own a cyclical business because we're going into a recession, and you definitely don't want to own a small business because they won't be able to survive the recession. And, there will be cases where that's true. But the fact is there are thousands of small companies in the public markets right now. A bunch of them are in the value side of the equation, and some of them are going to survive and actually thrive. And the markets sometimes have a very hard time distinguishing it, and that's where opportunities lie. So you can go about that two ways. Betting that things that people hate because the story is so good on the other side, like the whole small value world on a passive basis, that'll probably be a very good strategy. I would think that if you put your money there now, 10 years from now, you'll be very happy with that decision. 1 year from now, you might not be, but 10 years you will be. The other thing which we're doing in the portfolio is finding specific companies in those universes that are, completely mispriced and could be worth, 3, 5, 10 times the current price. And there's a lot of opportunity there. You can say what you will about great companies like Apple and Amazon, but can they really go up 5 times from here? I mean, how expensive can they possibly become? And how big can they become? A little small value stock can definitely go up 10 times. And there's a lot of upside there. No one's thinking about that today, of course, but it's there.
Great. Well, Mike, thank you. We have a few other questions that I'm going to follow up with you on,
Okay.
and then we'll email out the response to the group. We're so grateful for your time and for your leadership with our investment strategy. And again, for everybody who's on the line today, thank you very much for being here. We wish that we were here in person, but we will look ahead and be optimistic that perhaps November that will happen. Otherwise, we'll make sure to use a format like this so that you can talk directly to our donors, fund holders, and partners about how we're doing and where we're going. So again, thank you very much for joining us today, and we look forward to connecting again very soon.
Thanks, everyone.
Thanks, Mike.